165 points on the Nifty. A lot of these FMCG stocks are actually doing well. So, not directly FMCG, but Titan, which comes under the consumption space, is doing well. It's been an underperformer, but, the stocks move to the high point of trade. Higher gold prices typically do well for jewelry companies because people tend to prepone their purchases in anticipation of further hikes in gold prices itself. In fourth quarter, you typically have the wedding season and anticipation build up to Akshaya Tritiya as well. We do have Britannia, which has moved to the high point of trade, as have other FMCG consumption names which have moved higher too. So the FMCG index actually comes up for you on the screen. Speaking about the consumption space, in a recent note that has been released by CRISIL, they expect growth of the FMCG sector to rebound by almost 100 to 200 basis points versus FY25 and FY26. They expect 6 to 8% growth versus 5 to 6% growth in FY25 itself. So to discuss the rise of this and the retail sector in quick commerce in particular, Anuj Sethi, who's the Senior Director at CRISIL Ratings, joins in. Anuj, if you could give us a sense of what were the inputs that you, took note of before making this projection, and what is this based on? Is it just a lower base, or is it something incremental that is coming by for the sector as well? And the 6 to 8%, what would be the outperformers? Which, according to you, would be the categories that would grow upwards of 8%, and which would be the ones which would grow below 6%?
Yeah. Good afternoon, and thanks for having me. We expect the recovery will be driven by both urban demand as well as rural demand. And we know that rural demand has been outpacing urban demand, in the last 3 quarters or so. So the factors which will help some recovery in urban demand should be the moderating food inflation, easing interest rates, and also a series of measures which are announced in the union budget to encourage spending, and therefore we expect some benefit to come to urban demand. And rural demand should continue to grow steadily thanks to the allocation which is made for welfare schemes, expectations of a normal monsoon, and expectations that there'll be a reasonable hike in the minimum support prices of crops as well. Having said that, this year our expectation of 6 to 8% growth is based also that there will be some recovery in volumes. It will largely be volume-led, about 4 to 6%, and the balance growth will come through realization improvement. Some players have taken some hikes to pass on the raw material inflation seen in certain categories, whether it is tea, coffee, copra, wheat, palm oil, and of late sugar and milk also prices have gone up. So our expectation is based on that. And the second part of your question as to which categories will do better than others, there are 3 categories, basically food and beverages, which is the largest, almost 50% of the market. And then we have personal care and home care, which is split almost equally, the balance 50%. Of these segments, we expect the food and beverages and personal care will be posing, mid-single digits growth, you can say, while the personal care, the home care segment, which did well last year as well, that should see higher margin closer to 10% in the road ahead.
Right. Anuj, good afternoon. Thank you for joining in. You mentioned that you're expecting this growth to be volume-led. Are you seeing something like that emerge on the ground, at least in the current quarter? What do you anticipate from these companies going into the fourth quarter as the results start trickling in anytime now?
Yeah, we expect some amount of volume recovery. It's already been seen in the rural side. While one more trend, what we have noticed is the larger packs are being less preferred. But the mid-size packs and the small packs, they are seeing quick pickup. And that has also been seeing the fact that quick commerce is growing pretty fast, and it caters largely to the mid and small size pack segment.
Right. Now, what's interesting is that you speak about some price increases coming in on the back of price hikes by the company. I would like to know your thoughts on whether there would be premiumization in this space as well. So if there was an element of mix change and that aids to the revenue, because that would then directly flow down to the operating profitability, which you expect it to be flat 20 to 21% after a 50 to 100 basis points decline in the last fiscal.
Yeah. Yeah. So some amount of premiumization will happen in certain categories, say like in biscuits, also in personal care and home care. But that will be in very select categories. There again, we are seeing introduction of small packs, which is happening. As quick commerce is expected to grow pretty fast. It already grew at almost 30% last year. Similar sort of growth expected this year as well. So some amount of premiumization will help, but that's built into that 2% realization improvement, which I said.
So does this quick commerce going forward, expecting it to grow at a similar pace, but as competition intensifies within this, do you expect that growth to sustain? And does quick commerce then become the fulcrum of the entire sector when it comes to distribution and thereby ensuring growth?
See, ultimately, quick commerce companies also need to make money. So it will be a balanced sort of thing as they capture market share. Things will settle down, as we move along. But it doesn't take away the convenience, of ordering and having the goods delivered within a short time. So I think both models will coexist. The existing models will coexist along with quick commerce. But the focus will also be of some of the FMCG players to have a greater share of pie in the quick commerce trade as well.
What we're trying to understand from you is that, and this is something that we spoke with PwC this morning as well, where they said quick commerce is growing, but it's growing, it's not growing the pie as much. The pie is still likely to grow in 6 to 8% sort of levels as well, as per your expectations, closer to 10% for the retail industry, as per PwC's expectations. In that, quick commerce is likely to gain market share from traditional trade. So in that sense, is there a benefit of quick commerce for the sector on the whole, where it is not contributing as much to the growth, but it's just substituting one channel for the other?
That's true. It's substituting one channel for the other at the moment. But see, as of now, quick commerce is largely restricted to the metro cities, the urban areas. That's the reason why, it's not adding to the overall pie. But, it's more a convenience type of shopping, if you were to call it that.
But is there any, case for quick commerce to continue to grow at this pace even beyond tier 2? Because there are challenges, right? A lot of people who are in the quick commerce space say that tier 1 and metros are where they see maximum traction. Maybe the economies of scale may not be as favorable when they move beyond. So then the expectation of the consumption basket improving by virtue of quick commerce moving beyond metros stands questioned.
Yeah, it can be a more metro-centric sort of arrangement, if I have to call that. Whereas the traditional channels plus the other e-com channels, they are also spreading their baskets, wider into more pin codes, if I have to call them. In fact, e-commerce has a significant amount of penetration in pin codes, even more than a traditional model, I would say. So all models will coexist, but quick commerce is more going to be a metro-centric sort of model.
All right, final question before we let you go. Is there any particular specific trend that is calling out to you right now amidst all of that you're seeing? Any micro trend which you believe needs to be watched out for? And from a risk standpoint, what are the risks to your thesis of 6 to 8% growth?
Right. See, one more trend, what we have been observing is that the traditional FMCG companies are also looking at increasing adoption of digital channels, and they are targeting acquisition of D2C brands as well. Besides, of course, what I said, the trend of lower price packs to counter competition, which rose significantly in the last couple of years, especially in the rural side. There were a lot of regional brands which perform better. So I think that is one. Second, the risk to the forecast is obviously if we have a subpar monsoon, I think the rural demand, which accounts for about 42% of overall demand, I think that could take somewhat of hit. And then there could be down trading, again, going back to regional brands, etc. I think that's the largest risk we see.
All right, Anuj, thank you so much for sparing time, joining us with your outlook on the FMCG sector, and looking forward to having you more often on the platform. There was the interaction there with CRISIL on the FMCG sector. We take a short break. We take the market at the highest point of the day now, the Nifty nearing 23,100. Somil Mehta of Mirae Asset Sher Khan joins in on the other side with a quick chart check and some trading strategies. Stay tuned.